When most people think about dividend investing, they picture retirees collecting checks or investors chasing high-yield stocks. But here's the truth. There's a dividend strategy almost nobody talks about, and it's one of the most powerful ways to build wealth quietly over time. In this video, I'll reveal what that strategy is, why it beats the common high-yield chase, and how you can start using it today, even if you're a beginner. If you want a plan that compounds wealth while paying you along the way, this is your roadmap. Let's dive in. The biggest misconception about dividends. Most people think dividend investing is about chasing the highest yield possible. Stocks paying 6%, 8%, even 10%. It sounds great until you realize high yields often come with high risk, poor growth, and companies in decline. The real wealth building power of dividends isn't in chasing yield, it's in compounding growth through reinvestment. That's the strategy nobody talks about. The strategy: dividend growth and automatic reinvestment. Here's the secret. Focus on companies that grow their dividends consistently, not just pay big yields today. These are businesses with strong fundamentals, rising earnings, and a history of increasing payouts year after year. Combine that with automatic reinvestment using DRIPs, which are dividend reinvestment plans, and you create a compounding machine. Every dividend buys more shares, which earn more dividends, which buy more shares. Over decades, this snowball becomes unstoppable. Here's why this strategy works better than high-yield chasing. High-yield stocks often cut dividends during downturns. Dividend growth companies, they tend to raise payouts even in tough times. That stability matters because compounding only works if the stream is reliable. Plus, dividend growth stocks often deliver capital appreciation alongside income. You're not just collecting checks, you're building wealth two ways. High yield fades, dividend growth compounds. Step 1, choose the right account. Start with a tax-advantaged account like a Roth IRA. Perfect for dividend reinvestment because withdrawals are tax-free in retirement. Or a traditional IRA or 401k. These are great too for tax-deferred growth. Or choose a brokerage account. Flexible, but watch out for dividend taxes. Step 2, pick the right funds or stocks. For beginners, start with dividend growth ETFs or index funds. Here's some examples. VIG, Vanguard Dividend Appreciation ETF. Or SCHD, Schwab US Dividend Equity ETF. Or DGRO, iShares Dividend Growth ETF. These funds, or funds like it, hold companies with strong dividend growth histories, so you'll get diversification and simplicity. Start with the dividend growth ETFs and go from there. Step 3, automate reinvestment. Enable DRIP, dividend reinvestment, on your brokerage or retirement account. Every dividend automatically buys more shares. No manual steps, no temptation to spend, and no temptation to time the market. This is the engine of compounding. Step 4, how much should you invest? Start with what feels doable. $200 a month, $500 a month, or 10 to 15% of take-home pay. As income grows, remember to increase contributions, especially when you get a raise or a big bonus check. Step number 5, the power of time plus growth. Here's the math. $500 a month into a dividend ETF at 7% annual return for 30 years, that's $610,000. Add reinvested dividends and you're easily over $700K, plus a growing income stream for life. Step 6, common mistakes to avoid. Mistake number 1 is chasing yield. High payouts often signal trouble. Mistake number 2, ignoring fundamentals. Dividend growth matters more than current yield. And mistake number 3, which is all too common, spending dividends too early. Remember to reinvest until your portfolio can fund real goals. Don't chase yield, chase growth and reliability. Here's a bonus, the 2-phase approach. Phase number 1, reinvest everything for maximum compounding. And phase 2, when your portfolio hits your target, switch to cash payouts for passive income. This strategy turns reinvestment into retirement freedom. Reinvest now, collect later. That's the dividend wealth formula. Here's a few common objections and some simple answers to help give you encouragement. Objection number 1, I don't know enough. I don't have the knowledge to start. Start with dividend ETFs. There's really no way to do it wrong. Complexity kills consistency. Objection number 2, I'll wait until the markets calm down. It's too volatile to try this right now. Markets almost never calm down. Time in the market beats timing the market. You don't have to be perfect. You just have to invest and leave it there. Number 3, I can't invest much. Will it really even matter? Start with just $50 or $20. Habits scale better than intentions. Remember, the dividend investing strategy nobody talks about isn't about chasing yield. It's about compounding growth through reinvestment. Choose dividend growth funds, automate contributions, enable drip, and let time do the heavy lifting for you. Start today and start simple. Open one account, buy one dividend ETF, and turn on reinvestment. Then repeat and scale. Quiet consistency beats loud predictions. If this helped and you want calm, practical finance videos that actually work in real life, please consider subscribing to the channel or leave a like. It's free for you and it helps me immensely. Join thousands of people just like you, building freedom one smart decision at a time.